Welcome to Ensuring Your Well-Being. I am Dennis James, the biking, dancing insurance man. And I am glad you're here with me today. We're going to have a great topic. And that topic is going to be about the types of annuities in the market today. And they're meant to do is for accumulation, retirement, and legacy. All right, so those are the key topics right there. There are a lot of different types of annuities available, and a big reason for that is, there's a major role in retirement planning. There's 10,000 baby boomers today, and a population of about 76 million people that are in retirement years. And, there used to be a lot of pension plans out there. Now, they're more what they call contribution type plans, and that's like 401ks and 403bs, etc. And there's just been a decline in the defined benefits. And also, people are living longer, right? So, as people are living longer, they have to have a source of income, and that's an ongoing stream of income, and that's exactly what your annuities will do. That's what they're meant to do, to be more safe and give you a stream of income. And we'll be getting more into that. You can't really count on just Social Security today. Obviously, that's a great benefit, right? When you work your whole life, put a lot of time in. And it's for sure a nice benefit that is available, and you can take it out just depending 62, 65, 67, and that changes, the younger you are. But anyhow, the other thing, there's low interest rate environment, right? And we've been dealing with that for a while, right? So the CDs, money markets. So that's why, you want to think of streams of income for yourself. It's important, obviously, to have money in the bank for emergencies and that type of thing, but when it comes to retirement and legacy planning, annuities are a great way to do that. And because it creates that safety and security. Now, keep in mind, I want you to understand that, I deal with life insurance, long-term care insurance, and annuities. All right. So I'm not a financial planner. Don't want to be a financial planner. I have guys, that's all they do. That's what they are. They have their Series 6 or 63, and, they're guys that can put you into different types of investments. So a lot of times those have higher rates of return, where your annuities really are not really set up that way, because it goes through insurance companies, insurance carriers, whichever, and there's hundreds of them out there. Now I will be eventually bringing on guys that's all they do is they have a securities license, and when you need mutual funds, stocks, and that type of thing, they're a good go-to. As long as they have the experience, and a lot of them do. All right. So with that being said, annuities. Number one, it's a financial product, and it goes through the insurance company. It's meant to do two things really: accumulate money on a tax deferred basis, right? And that tax deferral over a period of time is really important. All right, and then the other part of it is on annuitizing for that stream of income, right? So a lot of times you're close to retirement and you want to have a stream of income coming in. That's a great vehicle that is meant to that. And there's the immediate annuities, and we'll get into that more. And then, of course, the deferred income annuities, and you can have that with these variable annuities also. All right. Now, as far as deferred annuities, Now, deferred annuities is just like what it says, all right? It's deferring um, the money you put in there, and it could be, it could be putting in 25,000, whatever that is, and then you can also run payments on it, right? Where you're taking money and you're going to be putting money into it on a monthly basis, quarterly, semi-annual or annual, and that's can be anywhere from minimum 5 years up to 10, 15, 20, 20 plus years. All right, and that's how that deferral really works, right? Because you're not being taxed on it every year where you have to pay taxes on it. So that's the advantage of that type of a plan. And depending on how it's set up, you're going to create, when you annuitize it, that stream of income, and it can be a lifetime income. Now, deferred annuities, like I said, they have surrender charges. So when you put that money in there, don't think of taking it out. All right. They're not meant to take out because, depending on the particular product, insurance company, they all have surrender charges, and usually the minimum's 10 years, and it could go 15 years. And it's a sliding scale, right? So if you have it and you start taking money in the 12th year because you just feel like you need to do that, well, it's meant to, you're going to pay a penalty on that. All right. So it could be 10%. All right, versus when you took it out at 15%. And usually those surrender charges end over a period of time. Now, they have what they call crisis waivers, and what that is, upon a death or a disability, hospitalization, unemployment, those types of, when something like that happens, you come down with the terminal illness or you're going to be in a nursing home, then you don't have to worry about those surrender charges. All right. But outside of that, it is meant for long term. All right. And so keep that in mind. Now, there's different types of these annuities, like fixed traditional. You might have heard of them, fixed traditional annuities. And that's going to give you, like, just depending on the insurance carrier, it's going to be like 4%. That all varies, or it could be like a 2% guarantee. All right. Now, we know that inflation's a lot higher than that right now. So, with the deferral and all that, that's the benefits of having something like that set up in for you as the annuitant or the owner of the policy. All right. So, and then there's the beneficiary, right? Upon a premature death, if you haven't really used it, you want that to go to your beneficiary. That's usually your loved one or spouse. And then there's what they call indexed annuities. So that has a little more upswing to it. It's still like a fixed annuity, but it is tied to like the S&P 500, or it could be the Russell 1000, that type of product. So there's a little more upswing to that, but so it could have a cap of, like, let's just say 8%. If it ever went to 12%, well, they're going to cap it at 8%. There's participation rates and that type of thing, but those types of annuities do have a little bit more upswing, but there's also some more charges in that when it comes to fees and all that, right? Because, so as an example, let's just say you have the money and you put it in there, and it starts at 1,000. 1 year later, that period ends. What will happen is you're going to maybe it earns at 1,100. You could earn 10% on that, but let's just say that if it was capped at 8, you're going to get 8%. All right, it gets more technical than that, and I don't want it to sound that way, but when you're dealing with your insurance professional, that's the guy that's going to help you out, whoever your advisor is on that. Let's see. And then there's also a reset. So that's what's kind of cool. So every year it resets, right? So whenever that period of time is, it resets and it starts over. Now you can move the money around different types of funds, accounts that way. But when you do that, and these are also tax deferred programs also. So that makes it nice like that. And they call zero as your hero, right? So, if when the stock market crashed, well, you're going to get zero, but you're not. And, but you didn't lose 10, 15, 20% of everything you put away. All right, so that's the advantage of the security, the safety behind an index type product, and they are very popular today in the marketplace. And there's also, that guarantee, but keep in mind you are paying for the cost of all the administrative that comes into that. And then the other thing is what they call variable annuities. And it carries more risk, all right? And so that's like having your money, where it could be invested in like mutual funds. They have different sub accounts and that type of thing, and there's a higher investment performance. So it's gonna perform better for you, But again, it takes away the safety, and really the owner is the one that is going to, he's part of that investment risk. So, where with the other ones, it's more with the insurance carrier, right, creating that safety. All right, then, as far as when it comes to annuitizing, all right, so they have what they call immediate annuities, and that is something. Let's just say you have a lump, right? All of a sudden, you have a lump sum payment, and it could be from a qualified plan. All right, so let's just say a 401k, 457, whatever it would be. Maybe you came into, you sold a business and you have cash and you want to be able to move it into a hybrid annuity. Now, the thing with that, you're going to start taking an income right away. So that's going to be within 1 month, or you want to do it within 1 year. All right, no later than that when it comes to having an immediate annuity. And then there's different terms on that type of a product, okay? And so when I talk about terms, it could be where you have that lifetime income. It could be a straight life term, right? So you can get a lot of monthly income out of that, or it could be quarterly, semi-annual, whatever way you want it to be. And it's gonna be there upon death, though. With something like that, if it's gonna pay you for life no matter what. But if you die prematurely, let's just say in the 5th year, that money that's it. That's curtains right there. And then there is also what they call years, right? So it could be a term of say 15 years, 20 years, and then the money would end at that time. Or you could have a period is certain with life, all right? So it's going to pay less per month, but if you outlive that, let's just say you take it for 15 years and you live 25, it's going to continue to pay for as long as you're alive. And then they have with years, okay? So you could have the same thing there where it's, so you have it for, using that example again, 15 years, and it's going to pay for that, for that period of time for that year. And then it ends. But if you have it 20 years plus, including life, then it's going to pay out for as long as you're alive. If you die prematurely, let's just say in the 7th year with that, or the, like the term certain, it's going to pay the beneficiary the difference on that. And also, they have joint policies, so joint survivor, so it could be a husband and wife, and the benefit there is as long as you're both alive, it's gonna pay out, right? So let's just say I and my wife have that joint survivor. I die after 15 years and she continues to live. So as long as she's alive, it's going to pay in income with that. So there's benefits to that. And then you're going to hear about hybrid of annuities, right? So a lot of them are like with just the annuities I talked about, all right, with uh, the deferred annuities, the variable annuities, and the traditional, the indexed annuities. There's a lot of them out there, right? So I'm going really broad with everything I'm speaking about here, because you could have you could spend time on each one of this. I just wanted to give an overview on these, just to kind of give you a basic idea. Now, like hybrids can work a lot, like I said, the same way. A lot of times these have the long-term care riders on it, or they have it could be a nursing care rider. Different types of riders on there that kind of they create a stream of income. It could be a lump sum income stream. That way, and of course, a lot of people, especially with people living longer, having those kind of riders, I believe, are important to have. There's a cost for them, but if you don't have some type of long-term care insurance plan in place, uh, it for sure can have benefits to it. Medicaid compliant annuities, right? So I don't even do these. I work with experts that do that. So when something, I just had that come up yesterday, where there's a crisis plan, and a good friend of mine, one of his family members went into a nursing home, right? So uh, what that is, it's a single premium annuity. It doesn't build cash value. You have to be going into a nursing home, but when it's structured properly, it's a spend down tool. Instead of getting into it, it eliminates countable assets, and it really is protecting and preserving assets for the countable spouse, or community spouse, they call it. All right. So I have a video that's going to be going on my website for that, but it's not something I specialize in, but I for sure have the connections that can help you that way with that. Now, one of the things you have to consider whenever you have any type of, it doesn't matter what vehicle it is, when it comes to annuities, right? It's the same thing. It's right. There are fees. There's administrative fees. There's commission fees. And all these riders have fees. If you surrender the policy outside of what I told you, that is exempt. Also, if you go to annuitize, that exempts to the surrender charge. All right, so death, disability, and annuitizing the plan. All right. The other thing, things to consider is eventually at age 73 today. All right. So the way that works is called required minimum distributions. And what ends up happening when you turn 73, the government, they want to get paid. All right. They don't want you to defer these products forever. Right. They want to, start collecting some money with that. And so that's where that required minimum distribution comes in. So as an example, let's just say that today you turn, so what is it today? Today's the 11th of July. All right, today's your birthday. Congratulations. Now you have to, required minimum distributions come into place. So what that means is that for that year, come the following year, you have to, based off that amount, you have to start taking out taking money out of that particular that savings vehicle, that investment, that annuity. All right, and it's all based off your age, and so your age, the amount of money in there, and then they have what they call a mortality table, and so they look at that table. How long are you predicted to live, and you take that out, and that happens every year. As long as you have money in there. Now, let's just say that you use that money, and it still has it still has money, the interest in there. You're going to continue to pay on that no matter what. All right. Let's see what else. I think I covered a lot of the topics. One of the things, you have non-qualified plans, you have qualified plans, right? So, one of the things with non-qualified plans that in 2010 it was called the Patient Protection Act came into play. And what that is let's just say you have a non-qualified annuity. All right. And you're not going to use it for anything. You're not going to need it towards to help you in your retirement. All right. It's just kind of sitting there. One of the things you can do is you can take that and you can turn it where there's no taxes on it, because normally you would pay taxes over and above the what you put into it, right? So let's just say, yeah, you started at 50,000. That's what you put in, and now it's worth 150. Well, you're going to pay taxes on that gain, and if you take it and use it towards a long-term care insurance annuity like that, and there are a few of them out there, it becomes what they call a 1035 exchange, and you won't pay taxes on it because you're using it for a long-term care insurance upon in an event, right? So it's very cool. A lot of people don't know about it. There's a lot of different insurance carriers that offer it. There's one out there, Dennis James, being the bike and dancing insurance man, background with martial arts. I love the whole wellness side that this one particular insurance carrier offers. So there's benefits to that. Outside of that, you have to look at the big picture when you take out annuities, right? Because they are more long term for accumulation, safe. That's the advantages of them. Does when you annuitize, it creates a stream of income. And right, so there's a lot of peace and security on that. A lot of people will have 2, 3, 4 different types of annuities, and it creates that stream of income. And you can set them up different ways. Let's just say you want one to kick in when when you're ready for Social Security, or you want to have one, every 2 or 3 years. So you can set them up that way. And if you have any questions, I could be reached at 248-393-3146. My website is variousinsuranceplanning.com. So I'm going to be having, in the future, I'm going to be bringing on CPAs, accounting firms like bookkeeping, and different professionals. And because of wellness, I'm going to be bringing people that talk about that, and that could be with nutrition. It may or may not be a topic you're interested in, but what I would suggest is it's good to tune into it, because what you put in your mouth matters. So my wife and I, we try to pay attention to that. We're not angels, but I can tell you, being in my late 60s, I think because of the fitness level and the putting in more organic nutrition in. So those are going to be topics. Last thing would be with the pickleball. A lot of people, movement's a big deal. So people talking about, that are experts in pickleball and why it's important. And, e-bikes are a big deal today for seniors and that type of thing, all types of people. And golf, and I could go on and on. So those are going to be subjects I'm going to be getting into. My main focus is life insurance protection, long-term care insurance protection, and annuities, right? Safety, security for retirement legacy. All right. I want people to reach out to me. I also deal not only in the individual market, but I deal in the worksite market. All right, meaning there are products available for the worksite. Not to get into that, but because I'll have a separate topic on that. But things like critical illness or hospitalization, where it pays a quick cash flow right to you, especially with the cost of hospitals and that type of thing, right? So you don't have to go into your savings vehicles like annuities and that to pay for things. You're going to, these products are very inexpensive, and sometimes there's no underwriting on them, and there's benefits there. With that being said, I want you to have a great day, and I'm always available. All you have to do is reach out to me, and if I don't have the answer, I have experts that have the answer. Again, this is Dennis James with Various Insurance Planning, and thanks for tuning in. Let people know about who we are and what we do, and make it a blessed day.